Hey everyone, we're here with Jeremy, head of growth at Balancer Labs. He'll be doing a talk on building blocks of finance. And I'll let him take it from here.
Thanks. So today I'm going to be talking about how Balancer is being used as a building block in DeFi. My name is Jeremy Musigi, and I'm the head of growth at Balancer Labs. So starting with a quick overview of what Balancer is and how it works. So on a high level, Balancer is a financial primitive for people to build and innovate on, and it's designed to really be a fundamental building block for decentralized finance. And it makes many different apps, products, and services possible. And that includes reinventing systems of traditional finance in DeFi, but it also includes creating all new innovations that never really existed before. And I think that's where the long-term vision really is. So the protocol, the Balancer protocol is a generalized automated market maker, or AMM. And in that sense, it shares some similarities with Uniswap. But structurally, Balancer and Uniswap are actually fairly different. And I think by the end of the presentation, you'll see a lot of those differences. To start, Balancer has the flexibility to create liquidity pools beyond a simple 50-50 split between two assets. You can create liquidity pools on Balancer that can skew the weights of two assets as far as 98% and 2%, but you can also create pools that hold up to 8 different assets. So we'll dive more into that. So Balancer liquidity pools are smart contracts that hold between 2 and 8 tokens. These tokens are held in balance according to preset weights that are determined within the design of that specific pool. And these weights represent the proportion of the total pool value that is represented by each token. So here on screen, you can see in the graphic a sample, like hypothetical Balancer pool that holds 7 different assets, DeFi tokens in this case, and a specific percentage allocated to each one. And every Balancer pool has customizable configurations, such as the tokens that are held in that pool, the weights of those tokens, and the swap fee that is charged for trades that occur involving that pool. So users who interact with Balancer can be split into 4 groups. The first being the liquidity providers, who come to Balancer to provide assets to Balancer pools and earn passive income from fees, as well as have their portfolio automatically rebalanced for them at no charge. Second, you have traders who come to Balancer to exchange tokens with low slippage and favorable rates. Third, you have smart contracts that are seeking to source liquidity from Balancer, and this can include, for example, DEX aggregators or smart wallets. And then fourth, you have arbitrageurs who come to Balancer seeking to profit from imbalances in price that occur anywhere on the platform. And they serve a very key role in how Balancer works, because by taking advantage of imbalances and arbitraging those trading opportunities, they are quickly actually putting pools back into balance according to their set weights. So there are a couple different types of pools on Balancer, and anyone can create a Balancer pool. The two general types are shared and private pools. Shared pools, when you create one, you set the configurations, and once that pool goes live, those configurations can no longer be changed. So they're finalized, they're immutable. That creates a trustless liquidity pool that anyone can then add or remove liquidity from, meaning that anyone can be a liquidity provider for this pool, for this type of pool. And a creator of a shared pool has no more rights than anybody else. On the other hand, private pools will also start with a similar process of setting configurations. However, when the pool goes live and as it's running, those configurations can actually be changed anytime by the creator, who is deemed the controller of that pool. And only the controller can add or remove liquidity to that pool. So those pools are not open for anyone to come in and permissionlessly provide liquidity. I'm going to go over one sample use case for each of these pool types, but there are many different use cases. A shared pool you can think of sort of like an index fund, where anyone who wants to earn passive income and keep their portfolio in balance can create or join a shared pool. And in return, they'll receive a BPT, Balancer Pool Token, which represents their portfolio ownership in that pool. And private pool can act more like a hedge fund, where a professional money manager can create a Balancer private pool and use it to allocate funds based on their own dynamic investing strategy. And since they are the controller of that pool, they can regulate who is able to invest in that fund. So a third type of pool is smart pools. And smart pools are essentially a private pool with a couple of tweaks that give it superpowers. The controller of a smart pool is actually a smart contract, and the smart pool acts as a gateway to allow anyone to add or remove liquidity trustlessly into this private pool structure. The controller is granted specified rights during the creation of the pool, and those rights allow it to make certain modifications or reconfigure aspects of the pool, such as the weights, the tokens, or the swap fees after the pool is live. However, those must all be defined upfront, and they can't be changed later. So for example, you could create a pool where the controller only has the right to change the weights of the tokens in the pool, but they cannot change which tokens will be held in the pool, and they cannot change the swap fee. And so since these are controlled by smart contracts, these, as any Ethereum smart contract, they can connect to any other smart contracts on the Ethereum blockchain, and they can thus act based on events that are occurring outside of Balancer and react to information and data that is on chain anywhere within the Ethereum network. And this is where the Balancer liquidity pools get really dynamic and things can start getting really interesting. So on that note, I'm going to cover a few of the real use cases today for smart pools. And I want to note that we most likely haven't yet discovered even a small fraction of the potential use cases for smart pools, because they're really just a fundamental tool or building block that can be applied in so many different ways. But the first ever smart pool was launched by PiDAO, and they use Balancer smart pools as the underlying infrastructure for their crypto index fund products. And this allows passive investing in diversified tokenized index funds that are designed to give consistent returns with managed risk. So examples of these index fund products, as shown here, are the USD++ pool, which is a Balancer Smart pool that holds 4 different USD pegged stablecoins. And this is designed to maintain risk managed exposure to the US dollar via crypto for investors. The BTC++ pool similarly holds 4 different synthetic or wrapped BTC assets, giving investors risk managed exposure to Bitcoin within the Ethereum ecosystem, and the DeFi plus L and DeFi plus S pools, which are large cap DeFi and small cap DeFi index funds. A second example of managed index funds on Balancer is Realty. Realty is a tokenized real estate investment platform. So token holders of Realty will receive rent from the actual tenants that are occupying properties that are tokenized on Realty, and that rent is converted into DAI and it's paid out in the form of a dividend. And using Balancer Smart Pools, Realty can create an index fund as a single token that represents a diversified investment in multiple real estate properties. So an example of this is that Realty could use this structure to create a hypothetical California real estate index fund. Using a Balancer Smart Pool that contains tokens that represent investment properties in different cities in California, like San Francisco, LA, San Diego, etc. And the way that this can be done is there can be many different smart pools that hold assets or hold tokens that represent properties, for example, in specific neighborhoods or towns in Los Angeles, taking the tokens from each of those pools, putting them together into a larger LA fund that is diversified across the city, and creating a meta pool or a pool of pools where the tokens, there could be a token for the LA meta fund, the San Francisco meta fund, San Diego meta fund, etc. And those can all be put together into a higher level pool, which can represent, for example, the entire state, the entire region, even the entire country. So a lot of really interesting opportunities are unlocked by this use case. So another use case that is becoming pretty popular for Balancer Smart Pools is token sales, or what we call liquidity bootstrapping pools, or LBPs. This is gaining a lot of traction as a new mechanism for conducting a fair and transparent token sale. So as a general example of this use case, you could say that there's a crypto project that is launching their native token, and they deploy a smart pool that contains their token and a reserve asset, such as a stablecoin. Let's take USDC, for example. And the pool can start with the weights skewed towards their own token. So 90% of the pool is their own native token, 10% of the pool is USDC. And this smart pool is designed, it's created with the rights configured such that the controller has the right to change the weights of the pool. So after this pool is launched, the duration of the sale is set, which could be, let's say it's 3 days. During this 3-day period, the team can then skew the weights of the pool gradually from 90-10 all the way to, for example, 10-90, meaning 10% their native token, 90% USDC, which effectively results in the project selling their tokens for USDC and raising that money for their project. This was done for the first time a few weeks ago by Perpetual Protocol. And these charts on the screen are from their LBP sale, showing the price discovery process and the chart on the left, and the final token holder distribution chart on the right, which shows a very decentralized base of token holders, which is definitely what they were hoping for. Oh, and the second LBP just took place yesterday by the Rally team. So another use case for smart pools is smart treasuries. This is based on a concept that was originated by Joel Monegro from Placeholder VC, which is an investor in Balancer Labs. And the idea is for crypto protocols to use Balancer Smart Pool to create a smart treasury that is then controlled by either the team or a DAO. And the concept is pretty complex. So for time constraints, I'm not going to dive into that, but I highly recommend reading the article if you're curious. It's called Stop Burning Tokens, and it's on the Placeholder blog. But kind of on a high level, this is a model that can replace the buyback and burn model that some crypto protocols have used with what they call a buyback and make model, which there's a strong case made in this article for why that's beneficial or superior. A few teams are already working on actually implementing this, and Aragon is leading the way on that. So yeah, great article to check out. Last use case that I'll quickly mention is surge pricing for trades. So in moments of high demand for liquidity in the crypto markets, people tend to be less sensitive to minor differences in trading fees. And they need to get liquidity at all costs, basically. Let me plug in here. So based on that fact, one can create a surge pricing pool, which dynamically can change its swap fees in reaction to market conditions by charging higher fees in times of heavy demand, and using that as an opportunity to basically generate higher fees or generate more fees per trade. This is similar to the concept of surge pricing on Uber. And this is a concept that we expect to be implemented, but we haven't seen it implemented yet. Last topic that I want to mention is the Balancer Ecosystem Fund. And this is how we provide grants and bounties to developers that are building on Balancer. And so by bounties, we mean specific ideas that our community has come up with that we want to fund developers to build because they bring value to the Balancer ecosystem. And grants are projects or ideas that developers come up with and pitch to us to get funding for the same purpose. So we just completed the first batch of grants for the Ecosystem Fund. We had 17 different recipients We're going to be announcing the details from that soon. But two of the awesome teams that we had the pleasure of funding were 1inch and Zapper. And we'll also have some other announcements coming soon from the ecosystem fund. So definitely stay tuned. And if you're interested, or if you have an idea that you would want to pitch, definitely get in touch with myself or anyone else on the team. And that's all. So thank you, everyone. Yeah, I don't know if I'm still live. I'm not hearing anything from anyone. So,
Jeremy, are you done presenting?
yeah.
Cool. So I believe there are some questions in the chat. Did you have a chance to answer them?
Okay, so email or Twitter to share. Yeah, you can find me on Twitter at IMMUTBL, immutable, just spelled kind of different.
Scroll up.
I'm sorry?
Do you want to scroll up? There are questions, I believe.
Okay. Are there any plans in place to provide introductions for noobs or people who are not particularly familiar with back-end finance, incentive programs, education? Yeah, I think education is a really important area for us to put some more energy into. I think Balancer is one of the more complex protocols to explain and understand. So, I mean, that's one of my challenges firsthand, is to kind of bring it to a level that's more digestible to people who come from different backgrounds, who aren't necessarily like math geniuses and computer science wizards at the same time, and like ex-Wall Street finance experts. So, yeah, that's something that we're working on. I don't have anything specific to announce yet at this moment, but the answer is yeah.
Cool. If there are no other final questions, we can take a short break, and then Tom from Dragonfly will be next. Awesome. Well, thanks, Jeremy. Appreciate your time.
Thanks.